Welcome to vTalkInsight, Allocator's Lens Daily for February 27th, 2026. Equities, bonds, credit, currencies, and commodities are all being pulled by the same forces today: a maturing AI trade, heavy fiscal stimulus, and elevated geopolitical risk, especially around energy. The question for multi-asset portfolios is how this rotation away from concentrated United States tech leadership is interacting with a renewed bid for fixed income and a more complex dollar and oil backdrop. In equities, the dominant story is that AI remains the macro theme of the year, but the equity expression of that theme is changing fast. Headline AI winners like NVIDIA continue to post exceptional revenue and profit growth, especially in data centers and inferencing. Yet the market is no longer rewarding those beats with the same enthusiasm. Several reports highlight NVIDIA and broader semiconductor stocks selling off sharply after blockbuster results, signaling that expectations have become stretched and that investors are reassessing how much future growth is already in the price. Against that backdrop, there is evidence of a notable portfolio rotation. Flows are moving out of semiconductors towards software, where positioning had been underweight by around 1 to 1.5 percentage points, and beaten down names are now seeing renewed interest despite earlier skepticism about AI monetization. At the same time, leadership has shifted toward more cyclical areas like materials, industrials, and energy, with recent gains described as pro-cyclical rather than defensive. Market breadth has improved meaningfully this year, with the share of S&P 500 earnings coming from the mega-cap group falling from roughly 3/4 to about half, and non-mega-cap stocks outperforming. Outside the United States, the case for international equities is gaining traction. Strategists at large global banks are reportedly tilting overweights toward emerging markets in Europe, noting that emerging market stocks have outperformed the S&P 500 for several consecutive months, and European indices have outpaced for even longer. Earnings growth is accelerating in Japan, Europe, and emerging markets ex-China, while United States tech and consumer discretionary sectors are seeing slower growth, and a secular theme of deglobalization and underinvestment in infrastructure and commodities is seen as a multi-year tailwind for value-oriented, inflation-sensitive markets. Fiscal expansion in Europe, China, and Japan, including a sizable German stimulus program estimated around 12% of GDP, adds another layer of support, and a gradually softer dollar is viewed as a bonus rather than a prerequisite for continued international outperformance. Within tech, the valuation picture is more nuanced than the price action suggests. Some of the largest technology companies now trade at valuation levels below those seen in past episodes of market stress, which has led certain large asset managers to maintain exposure to tech and communication services, arguing that much of the downside risk is already reflected. Yet software and SaaS names are under heavy scrutiny as business models pivot from traditional seat-based licenses to usage-driven AI agent models, making free cash flow far harder to forecast. Indices tracking software have dropped sharply year-to-date, and companies like Salesforce and Zoom have seen share prices fall despite decent growth and explicit AI strategies, because markets want clearer evidence of near-term monetization and are wary of disruption from cheaper, rapidly evolving AI tools. What stands out is that the AI narrative is expanding beyond a single hardware champion toward a broader ecosystem. Industrial automation, robotics, data center infrastructure, and regulated power networks are emerging as secondary beneficiaries of the AI build-out, and European energy names acquiring grid assets tied to rising AI power demand have been rewarded with outsized share price gains. Financials are also in focus, with large banks committing tens of billions of dollars to technology and AI investment, and there's growing interest in asset managers and private equity platforms as consolidation and M&A, such as bidding wars in the asset management space, push deal multiples higher. Even housing and consumer-facing sectors feature in the story, as lower mortgage rates below 6% could support spring housing activity, while retiring baby boomers gradually shift from earning wages to spending accumulated wealth, potentially cushioning consumption even as income growth slows. Despite all this churn under the surface, index-level volatility remains contained, with the VIX hovering below levels typically associated with acute stress, even after down days for the S&P 500. That calm masks concentrated wealth and risk in AI-related names and pockets of fragility in software-exposed private credit, which could feed back into listed equities if defaults rise. The bigger macro swing factor for equity risk premia is a potential supply-side shock in energy, where disruption around the Strait of Hormuz could simultaneously hurt growth and reignite inflation, challenging both cyclicals and long-duration growth stocks. For now, the equity market looks less like a simple risk-on or risk-off trade, and more like a complex rotation across regions and sectors, with AI still at the center, but expressed through a widening set of winners and losers. Turning to rates, government bond markets are trying to reconcile strong growth and aggressive fiscal expansion with signs of moderating inflation and the prospect of eventual policy easing. The Federal Reserve is broadly expected to stay on hold in the near term, with markets only pricing in a couple of rate cuts this year and no imminent move to shrink the balance sheet faster. Even so, several observers argue that a combination of a stabilizing labor market and moderate inflation makes some easing likely later this year, supporting a constructive backdrop for risk assets as long as there is no major supply shock. Within the curve, intermediate duration bonds stand out as an area of relative value, offering yields above 4% and the potential to repeat last year's return profile if disinflation and slower growth materialize more than markets currently expect. Recent performance bears that out to a degree, with the United States fixed income outperforming equities in February as investors rotated towards safer assets and rediscovered bonds as a hedge during equity wobble days. Globally, fixed income correlations are falling as inflation and growth regimes diverge, creating selective opportunities across regions and maturities, from United Kingdom gilts that yield significantly more than comparable French bonds, to rising Japanese government bond yields that are pulling capital back toward Japan after years of stagnation. Importantly, treasuries in the United States dollar continue to attract safe haven flows during geopolitical flare-ups, but there are louder questions about the long-term durability of that status given rising debt levels and debates over secular dollar weakness. For now, markets appear comfortable with high public debt as long as inflation expectations remain contained, and inflation, rather than debt itself, is seen as the key driver of borrowing costs. The largest tail risk to that equilibrium is a severe supply-side shock in energy that pushes inflation higher even as growth falters, which would challenge the recent return of bonds as a reliable hedge for equities. Near-term, break-even inflation and the long end of the Treasury curve have reverted to prior ranges, delaying the idea that a renewed inflation scare will derail the current pro-cyclical rotation. Credit markets sit at the intersection of the AI investment boom and the search for yield in a higher rate world. On the public side, AI-related corporate issuance has surged, with over $30 billion in deals so far this year, including a roughly $20 billion multi-tranche issue from Alphabet, underscoring that bond markets are a primary financing channel for the data center and AI infrastructure build-out. At the same time, major cloud and hyperscale companies are leaning more on debt to fund CapEx, which is starting to raise questions about balance sheet quality and echoes some of the dynamics seen in late 1990s tech financing. Beneath the surface, the more acute stress is in private credit, particularly where exposure to software is high. Industry data suggests that nearly a quarter of private credit portfolios are tied to software companies, often with leverage around 10 times EBITDA. Incredible forecasts see default rates in direct lending rising to 4 to 6% overall, and as high as the mid-teens for software-heavy books. Liquidity risk is front and center for funds with sizable retail investor bases, where redemption requests can clash with the illiquid nature of underlying loans, and recent headlines around large managers issuing bonds shortly after disclosing significant loan losses have added to scrutiny. Despite that, the broader message is not one of systemic credit deterioration. Asset quality across many private portfolios remains solid, with large asset sales still clearing near par value, and business development companies continue to see net positive inflows, indicating that appetite for private credit exposure persists even through bouts of volatility. Investors in public credit are increasingly gravitating toward higher quality segments, citing tight spreads and limited compensation for taking incremental risk, while asset-based lending backed by tangible collateral, such as aircraft, infrastructure, and manufacturing assets, is viewed as well aligned with themes like reindustrialization and supply chain reshoring. Importantly, software exposure in public credit and equity benchmarks is relatively small, which suggests that higher defaults in private software loans are more likely to be a contained problem than a broad contagion channel into the wider financial system. In foreign exchange, the dollar is caught between a structural bearish narrative and near-term resilience driven by growth and risk dynamics. On one hand, heavy United States fiscal deficits and long-term questions about the role of treasuries as the world's ultimate safe asset underpin expectations for secular dollar weakness. On the other hand, recent GDP and purchasing manager data point to a still robust United States economy, and that strength has so far prevented the structural story from translating into a sustained dollar downtrend. Market participants are essentially waiting for a clear cyclical catalyst to drive the next meaningful move, as structural themes alone have not been enough to weaken the currency decisively. The yen remains structurally weak, weighed down by years of low growth, high public debt, and negative real yields, even as Japanese government bond yields finally edge higher. That slow normalization in yields is drawing some capital back toward Japan and has important implications for global bond allocations, but it has not yet translated into a sustained yen rally. The result is a currency that can be volatile around policy headlines and intervention risks, yet still functions as a funding currency in many strategies. The Australian dollar is another focal point, benefiting from a combination of domestic central bank dynamics and its role as a liquid proxy for Chinese growth and the yuan within the G10. As markets reassess China's outlook and watch for stabilization or fresh stimulus, the Aussie becomes a key barometer for Asia's sensitive risk, sitting alongside the dollar and yen as a cross-check on equity and commodity moves. More broadly, gradual dollar softness, when it appears, tends to reinforce the recent tilt toward international equities and emerging markets, although the case for those assets currently rests more on earnings growth, valuations, and policy flexibility than on currency tailwind alone. Commodities round out the cross-asset picture, sitting at the junction of AI-driven energy demand, geopolitics, and supply imbalances. Oil prices are edging higher, with Brent around the $70 area, as traders weigh a persistent global glut against a rising geopolitical risk premium. On the supply side, surplus barrels from Russia and Iran and softer demand from large importers like India and China are capping prices, yet tensions in the Middle East, new United States sanctions on Iranian oil, and the ever-present risk of disruption around the Strait of Hormuz keep a meaningful upside tail in focus. A severe disruption to Gulf infrastructure or shipping lanes, through which roughly a quarter of global oil exports transit, is widely cited as one of the most significant risks to both equity and bond markets. Natural gas and power markets are increasingly tied to the AI theme. Forecasts point to rising gas demand as thousands of new data centers are built, driving sustained investment needs in generation and grid infrastructure. Energy equities linked to regulated power networks and gas production are described as undervalued beneficiaries of this shift, with some European names rallying strongly after acquiring grid assets that position them for AI-related power demand. Logistics are feeling knock-on effects as well, with the closure of the Suez Canal forcing ships to reroute and a surge in data center construction boosting demand and pricing in air freight, even as other freight segments, like duty-free e-commerce shipping, soften. Gold continues to perform its traditional role as a hedge, supported by escalating United States-Iran tensions, fresh sanctions, and a broader sense of geopolitical unease that adds to ongoing de-dollarization debates. Beyond energy and precious metals, industrial commodities and chemicals tell a story of structural change. European chemical production remains well below pre-pandemic levels due to elevated energy costs. China's chemical sector faces oversupply in basic products, but resilience in specialties, and both regions are expected to see more consolidation over time. All of this ties back into the broader narratives of deglobalization, reindustrialization, and underinvestment in capacity, which support the view that commodity-linked and value-oriented international markets may have a multi-year relative tailwind, even if near-term pricing is dominated by cyclical swings and geopolitical headlines. Pulling it all together, the cross-asset picture is one of rotation rather than rupture. Equity leadership is broadening away from a narrow United States mega-cap AI trade towards cyclicals and international markets, even as AI remains the central narrative driving capex, sector earnings, and corporate strategy. Rates markets are cautiously reasserting bonds as a portfolio hedge, anchored by expectations of moderate inflation and eventual Federal Reserve cuts, yet still exposed to the twin risks of fiscal strain and an energy shock. Credit is acting as the primary funding engine for the AI and infrastructure build-out, with public markets looking orderly while private credit digests concentrated software exposure and liquidity challenges. In currencies, the dollar sits in a holding pattern between structural bearish arguments and near-term resilience, while moves in the yen and Australian dollar offer important signals on regional growth and risk appetite. And in commodities, the tension between an oil glut and acute geopolitical risk, combined with rising AI-related power demand, makes the energy complex the key swing factor for both inflation and growth-sensitive assets. Over the coming days, the most important signposts will be evidence of real AI monetization in software and services, any shift in inflation expectations linked to energy, and how credit markets absorb ongoing issuance tied to data centers and private credit restructurings. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.